This course is Financial Management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this class, we will use the excellent text by Brigham and Davis, Intermediate Financial Management. In this lecture, we will cover Chapter 4, Bond Valuation. We will do an overview of the key features of bonds, figure out how to value bonds, look at the different ways of measuring yield, and assessing risk for bonds. As we continue the process of calculating the intrinsic value of a company, we will need to know how to calculate the cost of debt. That will be one of the components of the working average cost of capital. That is the primary purpose of this chapter. Key features of a bond. For the purpose of this chapter, we will assume that all bonds have a face value or par value of $1,000 paid at maturity. The Wall Street Journal makes a different assumption of $100. Obviously, different bonds have different par value amounts. The coupon interest rate will be defined as the stated interest rate. You multiply by the par value to get the dollars of interest that are paid. For most of the bonds we will study, this will be a fixed rate of interest for the life of the bond. The maturity is the years until a bond must be repaid. It declines over time. At issuance, government debt has a variety of maturities going up to a maximum currently of 30 years. The issue date is the date when bonds are issued, and default risk is the risk that the issuer will not make the interest or principal payments. For government debt, it is assumed that there is no default risk. For private sector debt, there can be a default risk. Of course, this would only apply to a government that can print currency in the same currency as the bonds, unlike a place like Greece, which cannot print currency in euros, but issues debt in euros. Many bonds have a call provision. Most government bonds do not, but most private sector bonds do. In this case, the issuer can refund if the rates decline. That helps the issuer, but hurts the investor. This would be equivalent with a home mortgage of refinancing your mortgage if interest rates drop. Therefore, borrowers are willing to pay more and lenders require more on callable bonds. Most bonds have a deferred call and a declining call premium, meaning the bond perhaps cannot be called for 5 years, and the amount of refinancing costs they pay will be perhaps, $50 in 5 years, $40 in 6 years, $30 in 7 years, etc. Many bonds also have a sinking fund provision. This is a provision to pay off a loan over its life rather than all at maturity. The equivalent for a bond as a amortizing home mortgage. This reduces the risk to the investor since there is always a market for selling the bonds. It also shortens the average maturity. It's not good for investors if rates decline after the issue, in which case they would prefer to get the higher rate. Sinking fund provisions can be handled in two different ways. Of course, the issuer will do whatever is cheaper for the issuer. They can either call X% at par per year for sinking fund purposes, and they're going to do this if RD is below the coupon rate and the bond trades at a premium. So this would be a mechanism for them to not have to pay the premium and still be able to buy back the bonds at the lower par rate. The other possibility is they could buy bonds on the open market. They would do this if instead of having fallen in the previous example, interest rates had increased, therefore the bonds are trading at a discount, and they can buy them on the open market at below the par rate. Now we'll consider the example of a 10-year 10% coupon bond if RD also is 10%. Therefore, the bond will trade at par since the interest payments made on the bond are the same as the interest rates demanded in the market. So we see here, we look at the value of our bond. It pays $100 every year, our 10% of $1,000 face value. It does this every year out for 10 years, and then at the end of the 10-year period, you get your $1,000 face value back. We can confirm that this bond trades at par by discounting each of these interest rates. For example, 100 divided by 1.1 is 90, and then you can do the second year, have 100 divided by 1.1 squared, then 1.1 cubed, etc., and sum out all of these payments, and you'll end up with $1,000. This can be split into the two different components, the present value of the maturity value. So the 385.54 is going to be 1,000 divided by 1.1 to the 10th, whereas the annuity is the sum of each of the individual interest payments, 100 divided by 1 plus 100 divided by 1.1 squared plus 100 divided by 1.1 cubed, going all the way out to 10. You can get your financial calculator to do this for you, or you could also do it in Excel. To use the financial calculator, such as the BA2 Plus, you would take the number of years 10, hit N, 10, hit interest rates, 100, hit payment for the payment every year, 1,000, hit future value, and then hit compute present value and get negative 1,000. So what would happen if expected inflation rose by 3%, causing interest rates to go up? If interest rates go up, bond prices go down. So we repeat using our financial calculator, the previous calculation, 10 hit N, 13I, 100 payment, 1,000 FV, compute PV, and we now get minus 837.21. Again, the way the financial calculator is set up, any payment you make, like buying the bond, is negative. For example, buying the bond for 837.21. Any payment you receive, like your payments every year and your final bullet value, are positive. So interest rates go up, bond prices go down. In this case, the bond will be trading at a discount below par at 837.21. What about if inflation fell and the required rate of interest in the market declined to 7%? Now, of course, our bond will trade at a premium above 1,000. Again, with the financial calculator, 10N, 7I, 100 payment, 1,000 FV, compute PV, and get minus 1,210.71. As shown in other videos, you can also do this on Excel. Well, now let's look at how these bond values change as time changes and the bond approaches its maturity. Suppose the bond was issued 20 years ago and now has 10 years to maturity. So initially it was a 30-year bond, it's 20 years have gone by, now it's a 10-year bond. What would happen to its value over time if the required rate of return remained at 10%, or at 13%, or at 7%? And we'll look at the next slide. So over time, the bond has to approach its maturity value or par value of 1,000. If the bond is trading at a premium, that means over time, gradually the price of the bond must go down to 1,000. And if you purchase this bond, you would experience a capital loss. Whereas if you purchase the bond at a discount, then over time, that bond price must gradually increase to the maturity value. If you purchase the bond at par, it would just stay the same to the maturity value. So in each of these different examples, you would get a different combination of capital loss or interest. In each case, you're going to get the $100 in interest every year, but in the top case, you get a capital loss that reduces your rate of return to 7%. In the middle case, you get no capital gain or loss. And the bottom case, you get your 10% interest plus a capital gain that increases your rate of return to 13%. And of course, the interest and capital gain or loss are taxed differently, at least if you are in a taxable, not a tax-deferred account. So at maturity, the value of any bond must equal its par value. The value of a premium bond would decrease to 1,000. The value of a discount bond would increase to 1,000. And a par value bond's price stays the same. Now, how about interest rate definitions? First one we will look at is the yield to maturity. And the yield to maturity, or YTM, is the rate of return earned on a bond held to maturity, also called the promised yield. It assumes the bond will not default, which is generally a good assumption for government debt, for a government issuing debt in its own currency. It's not always an assumption that is good for private debt. How do we calculate the yield to maturity on a 10-year 9% annual coupon bond with a par value of 1,000 selling for $887? So in this example, you will purchase it for $887. You will get $90 a year for 10 years, and you will get your $1,000 bullet payment back. This is a hard calculation to do by hand. Basically, you guess over and over again until you get the answer right. Computers in your calculator are very good at doing this, but you will notice even with the calculator, it takes a little time for it to think and give you the proper answer. This is the equation you would be confronted with if attempting to solve for RD, the yield to maturity, by hand. And the only way of doing for this is to guess an RD over and over again. So you would guess an RD. If you end up with a VB that is larger than the desired 887, then you would guess a larger RD. If you end up with calculating a VB that is smaller than the 887, you would guess a smaller RD. And you would do this over and over and over again and do this full calculation until you get 887. Humans are very slow and inefficient at doing this. Computers and calculators are reasonably quick, but they still think a little while. So to do it with your calculator, you do 10N minus 887 PV, 90 payment, 1000 FV, hit compute I, it thinks a little while, and gives you 10.91%. And again, Excel has a similar equation that we will show how to use in a separate video. So if the coupon rate is below RD, i.e. interest rates have gone up since the bond was issued, the bond will sell at a discount. If the coupon rate equals RD, the bond sells at a par value. And if the coupon rate is greater than RD, then interest rates have dropped since the bond was issued, and the bond will sell at a premium. I.e., if interest rates go up, prices fall. If interest rates go down, bond prices go up. And the price must equal par value at maturity. Example, find the yield to maturity if the price of the bond is $1,134.20. Well, in this case, it's still a 10-year bond, so you get 10N minus, since it's something you're paying to purchase the bond, 1134.2 PV, So this is what I pay in, these are what I receive out, this is negative, these are positives. 90 payment, 1000 FV, compute I, and get 7.08. And as a check, we know since our bond is trading at a premium, the yield to maturity must be below the 90 divided by 1,000, or the 9% coupon rate. So the bond sells for a premium because coupon equals 9%, which is greater than the required rate of return in the market of 7.08. So the bond's value is greater than par. More definitions. The current yield is the annual coupon payment over the current price. Since the current price can change, go up or down, the current yield can go up or down throughout the price of the bond. The capital gains yield will be the change in price in a given year over the beginning price at the year. So the yield to maturity is going to be the expected current yield plus the expected capital gains yield. And this is going to be taxed, the current yield, at whatever the purchaser of the bond's interest rate is, at least for an individual, a little different for a corporation. And capital gains yields are generally taxed at a lower rate for an individual. That would go on the Schedule D for the capital gains and the Schedule B for the interest. In our example, we have a 9% coupon. 9% times 1,000 is $90. So $90 in interest received each year over the price of the bond of $8.87. So the current yield is 10.15%. And if we know the yield to maturity is 10.91, the current yield is 10.15, we can take this minus this to get our capital gains yield. So the capital gains yield, yield to maturity minus current yield, 10.91 minus 10.15, or 0.76%, positive per year, since our bond is, in this example, going to be trading at a discount. You could also calculate this by finding the bond prices in years 1 and year 2, get the difference, divide by the value in year 1, and in this case, you should also get 0.76%. Well, not all bonds pay interest only once a year. We have semiannual bonds that pay interest twice a year. There are also quarterly bonds, maybe monthly bonds. How do we change our calculations for semiannual bonds? Well, N does not represent the number of years. It represents the total number of payments. So you take the number of years times 2 if it's twice a year. I does not represent the interest rate per year, but the interest rate per payment. So we would take the RD, divide by 2. Present value, the price you pay doesn't change. Future value doesn't change. But you only get half of the total annual interest rate over 6 months. So the coupon payment is interest divided by 2. Let's consider a 10-year, 10% coupon semiannual bond if RD, the required rate of return in the market, is 13% per year. Well, it's a 10-year bond, but you get 2 payments every year, so there's 20 payments. It's a 13% interest bond, but you get payments every 6 months, so the interest rate every 6 months is 13 divided by 2, or 6.5. Each of the yearly payments is $100, or 10% of 1,000, but that's split into 2 payments, one every 6 months of $50. 1,000 stays the same. Hit compute PV on your calculator, and you get minus 834.72. So your bond is trading at a discount. You will get a capital gain over the life of the bond, and the capital gain plus the interest payment of $50 will give you an annual 13% rate of return. In another video, we will, of course, go through how to do these bond calculations on Excel. How do we adjust things for callable bonds, and how do you calculate the yield to call? Well, we'll consider a 10-year, 10% semi-annual coupon, $1,000 par value bond selling at a premium for $1,135.90 with an 8% yield to maturity, and it can be called after 5 years at $1,050, so the extra $50 is the refinancing fee. Interest rates have dropped from 10% to 8%, so the bond is trading at a premium, and there is an incentive for this company to call back, pay off, and refinance the bond, just like if you had a home mortgage and interest rates drop from 10% to 8%, it might be advantageous for you to refinance the home mortgage depending on how big the refinancing fees are. First thing we will want to figure out is the nominal yield to call. So we're told the callable bond can be called in 5 years. 5 times 2, since it's semi-annual, means 10 payments. The current price of the bond is $1,135.90. The bond pays $50 every 6 months, and you have to pay an extra $50 in call premium to call it, so the future value in this case would be $1,050. And you compute I, you get 3.765%, which is the semi-annual yield to call. You multiply by 2, and you get 7.53%. So in this example, an investor in this bond is not going to make the 8% yield to maturity, most likely, because most likely the bond will be called in 5 years, and they will only make the 7.53% rate of return. So if you bought bonds, would you be more likely to earn the yield to maturity or the yield to call? And the answer is going to be the yield to call, because the issuer of the bond will do whatever is in their best interest. And they could, raise more money by selling new bonds at 7.53%. Obviously, there are experts at companies that look at this kind of stuff all the time. So bonds would normally price at their yield to call. If you study home mortgages, a lot of individuals who own houses and have mortgages don't refinance, even if it's their best interest. So there's actually a psychological component when valuing home mortgages, and you have to look at how much interest rates drop before people do refinance. So in this example, of course, with the corporation, could thus replace the bonds, which pay $100 a year, with bonds that only pay $75.30 per year and could trade at par then. And investors should expect a call, since the yield to call of 7.5 is below the yield to maturity of 8. In general, if a bond sells at a premium, then the coupon is greater than R or D, so a call is likely. So expect to earn the yield to call on premium bonds if interest rates have dropped, and the yield to maturity on par and discount bonds. Here ends the first half of the lecture on bonds. The rest of this chapter will be covered in the next video. I thank you for watching this video.